follow on with a presentation by Etienne. And then after that, we'll move it over to Michael to help coordinate the discussion. So that's going to be the order of the day. Thank you for joining us. We acknowledge the distance and the legwork to get you here. Thank you. Let's know if lunch or a bite is in order. We'll make provisions. Or if you need a refill of water, we're happy to provide. Thank you.
Thank you very much. So as you said, an intimate setting, so I don't know if I should sit down, but maybe I'll follow along with you and stand up. So it's great to be here, I have to say. You said a long distance. Typically, most of your faces I've seen in the distance between me and my laptop screen. So it's really nice to be out here and, particularly having a conversation on this topic that is important to us. Also to introduce myself. So on behalf of the African Development Bank, where I work, and my director at Sukotoda, who would like to be here. She's the Director of Agricultural Finance and Rural Development at the African Development Bank. For us, this is a particularly important conversation, and we are glad to see a lot of increasing interest in this. And this is particularly at the bank. There's been a renewed effort to think about how to systematically provide support to financing of agri-SMEs. Because as a large, AAA rated multilateral development bank, agri-SMEs are not our typical bread and butter. But as we are committed to the agricultural transformation for a whole range of the development impacts that are our mandate, there's no way we can look further than agri-SMEs. So about 2 years ago, the bank set up a specific program on agri-SME development and innovative financing. And I am the lead for agri-SME development innovative financing. So started with one person, but the program is rapidly building. And building also because of the partnerships here. So thanks to Safin also for inviting us here. Safin and its network of partners have been very critical, as explained to us, also thinking about what is fundamental to ensuring unlock finance for agri-SMEs. So we're supposed to talk about finance for agri-SMEs in the times of crisis. Right? And when you think about financing and SMEs, a crisis, you look at crisis from a lens of risk, right? And so you wonder, is there ever a time that agri-SMEs don't face some risk? Particular agri-SMEs in Africa. So when, right now we have the newest threat. It's a big threat, of course, rising prices, fuel, commodities, and inputs for as a result of Ukraine. But if you think about the context of the African agricultural system. It's a system that understands risk and has grown to be resilient with risk. Because if it's not Ukraine, it's COVID, and the wrong productive impacts of COVID. And if not that, it's locust invasions, or it's fall armyworm, or it's fake seed, or it's you name it. And despite this, there's still some resilience in the system. You still look around and you'll see, farmers are still producing. Livestock herders, boom and bust, they're still out there producing. And of course, across the entrepreneurial value chain, if it's the mama mboga or the vegetable lady and selling vegetable in informal markets, or it's the cooperatives that are aggregating dairy products to sell, or it's the fisherman who is selling his fish. They all understand risk from the point of view of the difficulty for them to access resources to grow, for the mama mboga to be able to get more produce, to be able to expand her revenue base, or the cooperative to be able to get a loan for a mini processor to upgrade to a yogurt, or a fisherman to get a mobile cold storage so that they can expand further afield and again increase their revenue base. So, despite this crisis that beset us, I think for us in this space, despite this systematic presence of risk, we should begin to recognize and maybe change the narrative toward the resilience that is there. Lest we pay the price for always being reactive and allowing the perception of risk or any new crisis have us now start rethinking what we need to do. Because we are in the business of risk and of providing a set of innovations. Ayodeji was talking about, what is the kind of capital that we need? How do we de-risk this? So colleagues, these are the things that I think we would want to ensure as we're trying to think through what are the set of opportunities, what are the solutions that we need to put in place. Excuse me. We need to take a step back, and I think this is what this conversation is going to be about. And let me just recall one of the challenges we face. So I'll tell you, we are putting together this new program. And just recently, we were working in the bank, African Government Bank, with a set of colleagues who are putting together a very interesting operation for an impact fund that has identified a whole pipeline of very bankable agri SMEs that were aligned with some gender financing principles and so on. They put together a package that also had de-risking mechanisms, first loss, and sub-debt and so on. But despite a well-packaged proposition that they had cooked for quite some time, they came to the Credit Risk Committee, and the Credit Risk Committee looked at it and said, I know you have guarantees here, I know you have sub-debt, but we think the risk is still too high, right? And so this narrative of risk, as we keep calling it, I think we should change the way we frame it, so that the products and the actions that we are putting in place to de-risk can be recognized by those gatekeepers of credit, and at the same time, unlock or minimize this sometimes unfortunate perception of risk that goes beyond any real risk that is in the system, right? So against this, if we step back and we look at this backdrop of concern of global recession, against this, the world is still awash with historical levels of credit. Several trillions of dollars that are sitting in, central banks in bonds earning 1 to 3% interest rates, very low interest rates. They're looking for opportunity. This is why you hear right now the biggest concerns in, the U.S. Central Bank, the Fed, and others is inflation, because of the historic low returns that all this credit is getting. So just imagine if we could figure out how to unlock just a slice of those trillions, right? To unlock them for what are the latest estimates? About 130,000 agri SMEs across the continent who are facing, say, about a deficit of 100 billion of financing annually, right? How do we convince those creditors who are willing to lock money down for a paltry 1 to 3%, that actually the returns here are quite good, or can be quite good? And you see, there are green shoots of progress. And if you look around you, I don't know if recently just last week, McKinsey produced a report. I think the report was called, sorry, this thing's not working so well for me. Who here has read that report? It was called the FinTech in Africa, the end of the beginning, right? Yeah. And what they highlighted is that just between 2020 and 2021, right, when we're going through the backdrop of the risks of COVID and supply chain problems and so on, right, the FinTech investments in FinTech in Africa tripled to 5,200 of them, 5,200, all receiving equity and capital from private investors. So despite that backdrop of risk, there's a lot of interest. Why is there this interest? And then if you look at these fintechs, how are they positioning themselves? The largest sector of these fintechs is retail and SME financing, right? So they're putting together a series of technology to be able to go directly to this otherwise risky SMEs. What's the second biggest subsector? Insurance, right? And a lot of this is also insurance for agriculture. So there's something that they know that we should be able to also help to leverage and accelerate. And how do we do that? Right? So I think just within this room, if we think about what are the key principles there, it's not that we have to start afresh, as I said, every time there's a new crisis, right? Just within this group, if I look back a bit, I met several of you. I imagine quite a lot of you were involved in the process of the UN Food System Summit, right? Toward the end of 2020, 2021, and I remember working with SAFIN and its other networks of partners, AGRA and GAIN, to serve as champions for agri-SME financing and innovation at the summit, right? And they had these process of game changers, which were very elaborate collaborative processes that were vetted by, myriad experts and practitioners. And from the point of view of the game changer that we led it, which was a game changer on establishing catalytic SME facility financing, there were three key core pillars that came about, right? And these pillars, they have withstood the state of time. The first is the requirement of concessionary capital, right? So this is, highly concessional, risk-taking capital that can really facilitate this de-risking of intermediaries to mobilize capital flows, right? And blended financing becomes key here. And this is one of the key frameworks that we begin to understand. How do we pull public sector resources that are otherwise going to, the billions going to agricultural subsidies that we know are not really as impactful as possible? How do we draw this public finance to further catalyze private sector and co-opt them to support the development impact requirements that we are seeking from, for example, the agri-food system? So first is accessing this concessionary capital and blending it appropriately. The second pillar is technical assistance, right? So technical assistance is required to ensure that, first of all, we increase the critical mass of these SMEs that are out there, ensure that they're bankable and that they can provide the signal of bankability that is required by the capital providers, right? And now this signal, the signal that is required is the third pillar. And the third pillar is really an impact mainstream. And why do I say impact mainstream? Again, back to the whole framework of blended finance, right? The only way you can pull capital to support the private sector, pull public capital to support the private sector, is if the private sector, in pushing for its for commercial viability, is likewise also making progress on a range of development impact concerns, right? So this is how you'll get this concessionary capital. This is how you'll get the grants for TA from the public sector. But you have to have mechanisms that can cheaply and credibly signal or certify the impact credentials of these agri SMEs, right? So once you are able to do that sufficiently cheaply enough that you can support with the TA agri SMEs to signal this, you get the financial intermediaries and capital providers to show donors and public sector governments that they are actually directing these resources to agri SMEs that are providing jobs for youth and for women, that are providing food that is healthy, that are providing in a green and sustainable manner. Then you'll start to see, we believe, the resources flow. And so if I could just, put a quick plug here, because certainly there's some nuances to these three principles. And you'll see different models. And later on, Aseli that has really, perfected a subclass of model under this blended finance will be giving some lessons. But if for us at the bank, these three pillars, working together with SAFIN, AGRA, and other partners in this game changer process, we were able to take these three, the lessons and the ideation we got from this process to put together and design our own, what we call the agri-food SME catalytic financing mechanism. So this is the ACFM. It's a special fund that has been launched by the African Development Bank just earlier this year. It's a $100 million Canadian dollar special fund. And if I could just very quickly, because we're here open for business, so let me just tell you, according to those three principles, what the ACFM does. So in terms of concessionary capital, So the ACFM, the special fund, provides concessionary debt and concessionary subordinated debt. 35% of the capital can be provided in this high risk tolerant form of subordinated debt. The recipients or the investees are these capital intermediaries, so impact funds, commercial banks, and agribusinesses that aggregate producers. All right. So, in terms of the second pillar, technical assistance, 20% of the total of the capital of the total fund is directed to TA. And TA can take several forms. It can be integrated with a loan to a capital provider to help them improve the systems that impact, that help them identify SMEs that are impact oriented. It can be directed to enterprise support organizations or business development service providers that are likewise, building this impact bankability into agri SMEs and so on. And then finally, of course, impact mainstreaming. These funds are able to be concessional. These grants within the funds are able to provide TA because of a focus on gender financing and climate. So any recipient will need to demonstrate their gender and climate credentials. So that's that. But ACFM, our fund is not the only one out there. There are many out there, and even as we are banging on the financing gap, there is still a question about how fast can we deploy these funds. There are lessons out there of funds that have come out, that have launched, and for several years have not been able to identify deals to deploy. So what is the challenge there? And I think that is something that, as I finalize and open up to our colleagues from ASELI, I want to remind you of the challenge that our investment officers faced. As I told you, when they went up to the credit risk committees. Right? These are issues of policy and regulatory constraint within the gatekeepers of credit in our institutions, whether it's in the banks, central banks, and so on. And so unless and until a set of regulations that do not credit the de-risking properties of these instruments that we are trying to provide, we're not going to unleash the full power of credit. So this study ASELI did, looking forward to hearing from Etienne, just highlighting some of these constraints that can be locked, and that we at the bank would like to partner with you, even discuss actively through this week on how we are really going to make these crises. They talked about in COVID to build back better, right? And that the silver lining of crisis, which I hear also affects, during the time of COVID, some of the silver lining shined on your operations as you increased revenue and expanded from Nigeria, I think, to Kenya and Uganda as well. So within this crisis and the insights that we get to understand and we'll be discussing, I really also want to throw a challenge that we take advantage of being here together, just the beginning of this AGRF, one of the most critical annual forums for agricultural stakeholders who are keen on transforming. And let's see how we can actually put together coalitions to continue to actually address some of the challenges that have been highlighted and unlock the financing for agri-SMEs. Thank you very much. I think should I pass it back to you to open for... All right, well, thanks a lot.
Thank you very much. Thank you. Welcome our additional guests. We're here to find solutions at the heart of agri-SME financing. And when we started, we said we want to work out with 3 items that are potentially actionable, and providers of capital can start to tweak their model, write check against, or get things to. So the conversation is going to get into we just had a great keynote from Andrew, and we're going to get into a presentation from ASELI by Etienne. And after that, we're going to have a conversation across this topic and try to see what our views, what our experience, what our anecdotes, and how can we start to reframe, the lessons that we can look at this problem. Thank you very much.
Thank you very much, Deji. made to leverage technology and use. It already has its limitations here, so it's not here. This one to leverage technology and share some visuals to help me explain what I see as complex concepts easily. So first one is, of course, when I'm asked to speak about financing agri SMEs in times of crisis, the first thing that comes to my mind is, well, agri-finance has always been in a crisis. So that should be very easy for me to talk about. And of course, Andrew, thank you for making the transition to this particular conversation. Obviously, I have one question for you. We can discuss much after this. That is me seeing an SME talking to ADB. It has always been quite a puzzle. So hopefully there are people in the room who also have similar question. So there'll be an opportunity for that. But let me start with a quick intro. My name is Etienne Ndatimana. I'm the head of operations at ASERI Africa. I'm glad to see I have a colleague here, Belize, at the corner. She's based here in Kigali. So if it is, you need to talk to ASERI in Rwanda, definitely that's your person. And I also recognize several partners that work with us in the room. So hopefully we'll have time to chat more with them. ASERI Africa is a development organization with a mission to unlock financing for agricultural SMEs. Now here's all right, thank you. So from the onset, we sought to actually understand why there is little financing going to the sector, yet this particular sector actually creates more employment in emerging economies, it contributes significantly to the GDP of the economies, but yet there is very little going on there in terms of financing. These numbers here, you can see in East Africa, 2/3 of the workforce actually engage in agriculture, yet only 5% of the commercial bank financing flows into that particular sector. That's really a huge gap. So we were curious now to understand the details. Why is there little lending happening in the ag space? So one finding after looking at the data from agricultural lenders, now we have looked at over 20,000 loan transactions from close to 40 lending institutions and covered billions worth of financing for the SMEs in dollar terms. Here are the critical key findings. One is we confirmed the hypothesis. Yes, lending to agriculture is very risky, but how risky is it? So we were able to quantify this. It's twice riskier as lending in any other sector for the same lender. So here we are looking at the loan write-offs. For example, across banks, generally looking at their entire loan book, in general, in East Africa, it's about 1.7% losses across. But if you look at the ag portfolio, it's around 3 to 3.5. So that's really double. We even went ahead and compared what's happening in Africa versus what's happening in Latin America. So in Africa, the risk is double what is in Latin America. Maybe those are many details. But what happens is not only lending to ag is risky, but it's also costly. Because obviously you have to travel miles, go to the rural area to look at a potential deal. And the higher risk and the cost when you combine actually now lead to lower returns when you lend to that sector vis-a-vis other opportunities available. So for lenders, there is an opportunity cost. And that's why you see them moving away from agriculture, because definitely the risk is higher, the returns are lower. I think if you're rational, you know the decision to make. For us, we're interested in agricultural SMEs. Why? Because that's where there is even much less lending happening Yet these are businesses that are actually serving well the rural economies. We have agricultural SMEs aggregating, the harvest from smallholder farmers, processing that, and getting it marketed, to the end buyers. They sell input, seeds, fertilizers to the smallholder farmers, and they contribute to food security and nutrition in the rural places. Some of the produce comes from their own processing, other produce comes from the big guys, but the guys who do the last mile distribution. So that's the segment you are interested in. For us to do this, we mobilize donor funding. So we are donor funded. And we use the money from donors to pay financial incentives for capital providers or many institutions into agriculture. You can see the list of our donor partners. We also fund technical assistance going to support SMEs or lenders to kind of capacitate them in lending well to the agricultural sector, which is quite novel, which is new to them. They are used to the traditional lending to where it's easy to make money. So agriculture is special. Over time, and as we do all this, we collect a lot of data, and we share the findings and learning to the public. Of course, that's free of charge. It's donor funded. In the next 3 or 4 years, we hope to unlock at least $600 million USD in lending only in East Africa. And we plan also to expand beyond East Africa. And that's the target for East Africa. And this lending, we estimate that it's going to help over 1 million smallholder farmers to improve their livelihoods. But more importantly, we want to demonstrate that this is viable and have our model replicated and done by many other people, because the challenge at hand is huge. We cannot do it. Financial incentives for ASERI Africa are of twofold. So one is what we call a portfolio first loss cover. For a qualifying loan, so there is a loan range and characteristics of a borrower who qualifies. If a lender has given a loan and reports that to us, then they earn a certain amount of money. It's a percentage of the loan value, and we put that in the reserve account. And of course, the more loans they do, the more they accumulate. And in case of any losses in that portfolio, then they can make a claim and they will be paid. That will reduce their losses from lending to the agri SMEs. And the amount, as you see, ranges from 2 to 9%. We run all these in USD. So if you lend in Rwanda francs, we convert that into USD and you keep the money in USD until such a time is lost. For origination incentives, which is meant to help lenders meet their costs of sourcing for deals, monitoring for the investments, and evaluating all that, we directly pay. As long as that particular loan qualifies, we pay. So they can use the money to probably hire more staff to source for deals, or do more visits, or improve their own systems and processes to lend more to the agriculture. So these can be as low as $2 or as high as $16,000. So unlike the first loss cover incentives, for the origination incentives, we use a smooth curve. So it doesn't go up with the size of the loan. Actually, the smaller loans earn more in percentage terms, because that's where we want to encourage lenders to focus. So the bigger the loan, the less you get as incentive, because it gets closer to the profitability level. But this is really what we are up to. So for now, as I said, ag is in crisis. I think we all agree it. So it's not profitable, and there is little going there, and lenders are very choosy. They select which deals are likely to make them money. So we hope to move within incentives from the unprofitable zone to the profitable zone. And how we do it is we want to shore up the revenue earned from a particular loan transaction by rewarding the lenders for giving capital to a high impact SME. And with that portion, you can see in the middle, in the graph in the middle, that now the revenue plus incentives is higher. So we are shifting that. And chances are the lender will actually do this deal. But we won't be there forever to subsidize lending. And that's really the catch when you're designing these mechanisms. They have to be an exit. So we're saying lenders, when they get used to actually doing deals in ag space, get familiar, improve their systems, there will be a time when they will need less and less incentives to support the sector. And that's what we hope to see in the future. Quick snapshot of the results to date. We are quite new. We're 3 years old. We spent the first year setting up and defining then our product offering. So in the last close to 2 years, this is where we are. We've been able to unlock $64 million US. The average loan size is quite small. And more importantly, the lending is happening where we want it to go. So to what we define as first-time borrowers, people are not able to get loans above, let's say, 25,000 USD. Because they were stuck in the microfinance, it couldn't go up. And that's really happening. Almost half of the loans we supported are going to those particular SMEs. And the impact we are seeking is where we're even happy, because you can see 2/3 of these businesses are gender inclusive. Half of them are contributing to food security and nutrition. And with the donor funding, we actually were able to mobilize. For every donor, $1 USD of donor funding, we're able to leverage $12 of private sector money. We learned a couple of things, of course, over time. So I won't get into all the details, but the point here is, for this to happen, there have to be a robust private sector. It just happens not to be interested in ag because they have other opportunities. If the private sector isn't active, isn't there, then this is hard to achieve. The other thing is, when we began this and looked around and did all the studies, we were thinking, these SMEs are somewhere on average borrowing 250K, between 250K and 300,000. But what we have seen in practice, they are much, much actually smaller. And that's where we think we are hitting really the target borrowers we're looking to support. As I had mentioned, on the impact side, these are the businesses driving the highest impact possible. But we are saying the model is also replicable. It can be rolled out in other parts of Africa or the world. It can be moved, it can be done not only on lending side, but also on, let's say, equity investments, in other sectors. So away from agriculture, it could be health, it could be education, and those other important sectors. Back to Andrew's, interest, which was about regulatory challenges. While we're trying to do this, and you have seen we have actually achieved some solid results. We just need to do more in the coming days. We also recognize there are serious regulatory challenges, and this is what explains why capital providers are shying away from the ag sector. So it doesn't matter how much subsidies we may provide, or technical assistance building pipelines, deals will be stuck somewhere because of these particular reasons. So we just named a few and provided the opportunities that comes with the challenge. Also, we're able to share a few examples of where we think some people have attempted to resolve the regulatory challenges. So I'll explain why very quickly. So the IFRS, International Financial Reporting Standard 9, came in to say, after the 2008 financial crisis, let's not now make provision for losses when they have happened. Let's do it the minute you take on a loan. So meaning you're already taking your scarce capital, put it aside, so you can meet those losses in the future. What does that mean? If agriculture is very risky, then instead of taking my $2 to cushion against this, to put them aside, I rather lend, say, for mortgage where maybe it's less risky, and I put in $1. It's very simple. So that's really the problem. But there is also one thing, if we want to really proceed, remember I began that agriculture is very important because of the contribution to the economy and so on and so forth. Then let's meet that particular challenge with some investments that are meant to capture the impact of agriculture and all those other important sectors. So I think that's where actually a selling model falls, because we're using donor money to actually provide incentives. So lenders can actually have appetite to lend to agriculture. We think over time, governments, if interested, can actually take this over. As subsidies, especially ag, are there, I don't think there is any secret about it. In the developed world, it's done. So why not in developing countries where probably the impact is much greater? The other challenge is around the capital adequacy ratio. So this one is actually, when combined with IFRS 9, then they definitely lenders will move away from agriculture. This one is looking at risk, weighted assets. So looking at the entire portfolio and saying, okay, the central bank has set, a minimum of capital that, an institution ought to have to stay in business. And that particular capital, if then it's taken into by lending to agriculture, which we say is actually risky, and by that you allocate more capital for that, that means definitely agriculture is the least priority for the lenders. Maybe before I get to the case in point where they have tried to resolve it, let me speak to the loan classification. Again, a deal or a loan, say in real estate or housing, and a deal in agriculture, we always have some differences. When you're looking at, let's say, delays in payments, and then you have to provision for X percentage that goes to the loss provisions. For example, you are a civil servant or an employee earning a salary, you borrow to buy a house. If you delay to pay, somehow, somewhere, I think things are starting to go wrong. But for agriculture, sometimes you may delay to pay simply because you could not harvest today. You harvest next week. Or transport, logistics were a problem to get them across. So, but because you have just crossed the 90-day classification, then you provision for more, but in actual sense, not like the underlying asset has lost value or is weak. It's just what's peculiar, what's specific to the agriculture. So we feel like if agriculture is treated like any other sector, those problems will always arise. Collateral requirements. This is, I think, the easiest in terms of dealing with. Agriculture happens in rural areas. And if you have a piece of land in the city, in Kigali, and a piece of land somewhere in west, south, or east of the country, same size, obviously the rural piece is probably worth a quarter of the value of land in the capital. yet does the land be used as collateral for borrowing. So meaning the value is very low, so you can only borrow so much that land value is going to allow you. So that's also an impediment to investing more in the agriculture. So the more collateral is required, the more problems we receive for the agriculture. Credit guarantees, especially when they are not funded, they are also not even considered to meet the capital adequacy ratio requirements. So again, meaning, there is less available to lend to the agriculture. So here, I wanted just to share two examples of where elsewhere they have tried to resolve a few of these regulatory issues. In India, they have set a minimum for every commercial bank, at least you lend 18% to the agriculture. That's the minimum. If you are not able to, then there is a penalty. You contribute some amount to a reserve somewhere that another bank can take and use for agriculture. So in the end, it's to benefit the agriculture. If you don't want to do ag, fine, put money there, we'll use it, avail it to another institution which can do it. In Uganda, just across the border, they have what they call the agricultural credit facility, which in essence provides capital for meeting half the loan value at 0%, which the government requires the lender to pass on to the borrower. So it works both ways. It encourages lending to the sector, but also at affordable rates for the borrowers. But we are not prescribing, we're just sharing examples. And we think a combination of all these solutions in one particular jurisdiction may work best than just picking one single solution. So I will stop there. And Deji, back to you. I think we can discuss more of these things in details. They are interesting, and I can stand here speaking the whole afternoon. So back to you. Thank you very much.
Hi everyone. Great to see that we have more people in the room. Thanks everyone for coming. Andrew, thank you so much for the keynote. Etienne for that great presentation. I'm actually going to, I think, attempt speaking without the microphone. I was brought up American, so I was brought up to project. Does that work? Or no, you need
you have to use the mic. Yeah, sure.
For recording?
Yeah.
Okay. All right, no worries. Essentially, I represent SAFIN, so I'm the technical specialist for the SAFIN network, or the SAFIN secretary. We're housed under IFAD, which basically serves as an incubator, but we operate as a network. And what that means is that we bring together a large number, well, not that large actually, we're about 53 institutions now, and growing, I would say. We really work on, I think, the quality of the types of institutions that we bring into the network over the quantity, mainly because we are very focused and the only network focused specifically on agri SME finance. So that's kind of a small world, as it were. And what we're trying to do is to bring really a broad spectrum of different types of organizations and people who work in that sector to represent basically all of the different facets of agri-SME finance. So our partners range from public sector institutions, DFIs, development institutions, through think tanks, philanthropic institutions, advisory institutions, consultancies, down to, well, through private sector, so finance institutions, impact investors, alliances of financial actors on the ground, and then also bringing in agri SMEs such as AFEX, and other actors that group up sort of cooperatives of farmers, for instance, which we include also in the agri SME, sort of missing middle segment. So we have a number of partners here, African Development Bank, obviously ASELI, AFEX, and IFAD, of course, and if I'm missing anyone else who might be in the room here, please let me know. It's good to know that we have some partners. So in that view, trying to understand, what we try to do with our partners is try to understand essentially across three main pillars, you know, what is motivating agri-SME finance. So there's a big part of it which is obviously around knowledge exchange and development, trying to share the learnings from our partners, and trying to basically sort of bridge the gaps. And I think that that's kind of what we would like to do here today, which is try to understand, you know, from other participants here in the room, you know, experts, people who actually work in the field, you know, what do you know? What can you contribute to the conversation around, you know, a lot of what we just discussed here and what was presented by both Andrew and Etienne. So we basically wanted to make this more of a conversation. So we really, you know, welcome you all to make your voices heard, share your experiences, share your knowledge, your opinions, so that we can try to sort of tease out some of the key pieces of knowledge that we might be missing or overlooking. And if we can go to the list of questions, we'll just put those up. So we've developed just some questions that are quite general, and we've got about, I'd say, 40 minutes. We might be going a little bit over time. You know, hopefully that works for most of you. We can sit around. And we'd like to go into some level of detail on some of these questions. And we'd also like to build on what was just presented by both Andrew and Etienne. And that means that in both their cases, they've essentially identified, you know, what they and their experience and their organizations see as some of the key challenges to agri-SMEs, and, you know, what their responses have been. And we'd like to basically turn to you and see whether, you know, out of your own experience, are there any of the key challenges that are being overlooked? You know, are there key lessons learned that should be considered? Are there, you know, elements of agri-SME finance that demand more attention as we look forward to sort of, you know, developing new models or scaling, replicating existing models? And so what I would propose to do, because we have two speakers, as it were, that were originally slated to speak as a panel. So Ayodeji Balogun, who's already presented himself, Nadine Bosa, who represents IFAD and the Food Systems Coordination Hub. And so maybe I can just start with both of you. Nadine, again, building on what we just heard, in your view, are there any sort of key elements around the challenges to agri-SME finance, or key learnings that haven't already been covered and that you think need to be addressed?
Well, thank you for giving me the floor.
Do you want that? Yeah. Is there a technician? Or another microphone? There you go.
Yes, thank you very much. And I think the presentation we saw was quite exhaustive. I actually have a comment on the second presentation where you actually mentioned that the level of risk in agriculture were much higher, and that's also the reason why the level of finance is lower. We have been arguing a lot that, yes, while the level of risk is higher, I mean, the level of repayment is also sometimes higher, and you also have different factors which are kind of reducing the risk. We were, for example, managing financing a project of IFAD in Nigeria, and we saw that when you were actually putting the value chain actors together, you had a significant way of reducing risk. Let me give you an example. We had a financial institution very enthusiastic about providing loans to smallholders and SMEs for the reason that you had different actors involved. You had, for example, IFAD providing technical assistance to the farmers in terms of training, in terms of also inputs, subsidizing part of the input in terms of support for land management. We were also working with local government, which were providing investment in the sense of water storage, or in terms of access roads. So what you see is that when you put actually the different actors of the value chains working together, the local governments, and supported by the donors, and we also had off-takers, which were interested in providing some of the financing at the beginning of the farming season. You had a very established opportunity to lower the risk. And in the different models and initiatives you have presented here, I haven't seen that kind of experience, but we really got the feedback that we were also working on the same thing in Kenya with Equity Bank, where they felt that it was profitable actually to extend financing to this target group because the level of risk was extremely lower because different actors were involved, and then they felt that this is a group where the risk is going to be limited. And so I wanted to see how you reflect that in the lesson learned, that really the value chain approach driven by the market, where the government, the off-takers, the technical service, extension service, I would say, work together to provide the right kind of support to the SMEs. You have the opportunity to lower the risk and attract other financial institutions. So in a way, I'm sharing a bit of learning that I didn't see reflected here, and whether you also consider that this is the right way to lower risk. Thank you.
Thank you for that. Etienne, do you want to answer? Just before I give you the microphone, I want to let everyone know that there's coffee outside if you need a little caffeine jolt to stay awake.